swear I only bought one coffee. This episode of Zurich's Money Mindset Podcast will be on everyone's favourite, or probably least favourite topic, inflation. We'll be talking about what it is and how to think about it with respect to your investments and your savings. Please check it out on the Zurich Money Mindset Hub. Hello and welcome to episode number 3 of the Zurich Money Mindset Podcast. Today we're going to be talking about a concept that is on everybody's mind, and that is inflation. Now, it is closely related to the concept of interest rates that we talked about in our previous episode, but I think it deserves a standalone episode in its own right. Now, what is inflation? It's basically prices in the economy going up over time. And why is that so important to the concept of savings and investment? Because without doing anything, the purchasing power of your money is being eroded through that inflation. It is absolutely crucial to make sure that you can do what you can to at least keep pace, hopefully, and this should be the intention with investing in the long run, beating inflation and making returns over the amount of inflation as well. But inflation is often hard to know in advance. I mean, even economists are quite poor at predicting it, particularly when it's really sudden, caused by very big surprising events. So it's really important to try and understand just how that influences you. Now, where have prices not gone up? Now that is with subscribing to us. That's still free. You can click that button to subscribe and like and comment. I know I've said that in a slightly different order than is normal. Hopefully the algorithm does not punish me for it. Here's the good news. Inflation in the world right now, as this is being recorded, is actually back down to more normal levels. It's close to what central banks and governments generally can be more comfortable with. The bad news is prices very rarely tend to go down, and we don't know what the inflation is going to be on the future. So we always have to be wary about that, particularly for the value of our investments and savings. Now, I think we all have our own experiences with inflation in recent years. I mean, one very, very salient example is, I think, if you want to open a bag of crisps or chips as they are called in America, you may be surprised to find now you probably find about 2 or 3 crisps in there for the same price that would have got you about 100 before. So that's an example of what we call shrinkflation, where the item is the same price, but it's offering you less in terms of the actual product over time. That is an example of inflation, and I think it's one that quite a lot of people may have seen just generally in the grocery stores. So it doesn't only impact your savings and investments, but it's generally in the economy. Now, prices generally do go up over time. We know that in all the historical data that we have. This is not a new phenomenon. What $100 could have bought you in 1950 is much, much more than it can buy you today. And by the way, inflation in of itself is actually not a bad thing. There are some good reasons that governments and central banks try and target small and stable amounts of inflation over time. But we do know that prices go up. One thing that can be quite frustrating to me about this is when you see new headlines or titles like "New blockbuster movie is the highest grossing of all time." You say, well, that's not really saying all that much, is it? Because the value of money and inflation has been very high recently, and that just means that it's a lot of money, maybe yes, in today's money, but if you compare it to previous times, it actually might not be as much as you think. That kind of comparison is what we would call in real terms. Now, that's a very, very important concept. We'll go into a little bit deeper in a later portion of the episode, but you need to think about things like that. So when we talk about inflation, we talk about rising prices, generally what people are talking about is consumer price inflation, or CPI, as it is called. There are other measures like producer price inflation, for example, but the most relevant one is CPI. Now, that is calculated by across the world by various national statistical agencies who collect prices of all sorts of items, ranging from apples to iPhones. and they will try and create what they will call a representative consumer basket. So the weight in that basket is basically meant to reflect what the average person is spending their money on. Now, as you will have known, or as you will no doubt maybe comment on over time or have heard people saying, is the median basket is not actually your own basket. Everyone has a different way of consuming. So everyone's consumer price inflation that they actually experience is always going to be a little bit different, but depending if they buy more of one thing or less of one thing, and the prices of that are going up more or less than other things. But at a big level, it is a good measure across the economy of inflation pressure. As I said, there are other measures like producer price inflation. That's if you are, a factory that is building end goods for consumers. Ultimately, you have inputs into that. The prices of those things, for example, even electricity may be going up considerably. You may or may not choose to pass that on to the price at the end of the day, but it likely does have some impact on prices over time. And recently, obviously, we've seen electricity prices, from 2021 and 22 and onwards have gone up considerably, and that did feed into high producer price inflation and ultimately high CPI. As I said, one of the positives right now is we're actually back to more normal levels of consumer price inflation, and that's really good for everyone in the economy. Now, how is that dealt with? Well, there are various ways, but the most salient one, which links back to our previous episode, is central banks themselves are often instructed specifically to target a inflation amount. A common number is 2% inflation. Now, when inflation is a lot higher than that, they raise interest rates considerably in order to try and basically discourage frothy activity in the economy and encourage saving. When the number is too low, they do the opposite, try and cut and try and stimulate the economy. That's the very classic example of how inflation is dealt with. Lastly, what is it that actually causes inflation? I used the electricity prices as an example there, but the reality is it's extremely complicated. It's hard to forecast and predict, and it's very hard to forecast what specific event is going to cause either a very large increase in prices or maybe a decline in prices, although those tend to be a little bit rarer. The good news is that over the long run, in our modern economies, there is strong evidence that central banks have been actually fairly successful at keeping inflation around that target level. Of course, there are times that deviates, but there is, I would say, some small good news there. And here's why inflation really matters for your savings and your investments. In episode number 1, I referred to the idea of saving money in a tin. Literally, it's sitting there, it's earning zero. While that is happening, inflation, as we said in the economy, is going up, either by design, that 2% target, or it's going up for other reasons much faster in an unwelcome fashion. In both scenarios, though, you are losing purchasing power with those savings that are not earning a return on that. That introduces or goes deeper into this crucial concept of a real return. Real. That's different from what we would call a nominal number, which is just a kind of normal number that we refer to, a 2% interest rate, for example. But if the inflation rate is 2% and you have a 2% interest rate, your real rate is basically 2 minus 2 is 0. So by earning 2%, you're keeping up with inflation. This is a super important mindset shift that I would recommend people think about quite deeply with respect to their own saving and investment decisions. At the end of the day, the real return is really what matters for you as a saver, as an investor. It is what you need to ensure that your savings and investments are going to be able to be used to meet the goals that you have for those saving and investments. Without having real returns, even if you had a kind of higher number at the end, it could be possible that inflation is still higher than that. So you have to be very, very cognizant of that specific number. So a fundamental question for you as a saver or investor is, are you able to beat inflation? And why is that so important? Now, I want to talk about two specific things here, and there are, I would say, some good news with respect to this. Point one, we are in a different environment as we record this for the real returns that are available to general investors and savers compared to the decade basically before 2020. That doesn't necessarily mean that it's going to continue into the future, but as we speak, there are some positive signs on that. Now, what do I mean? For the first time in a long time, assets like government bonds, which are, considered the safest, form, very highly rated, tend to be seen as, very kind of low risk, quite low return assets, very closely related to central bank interest rates in an economy. We are in an environment right now where those assets actually offer a positive real return in many cases. What does that mean? It means that when you compare the interest rate they offer versus the market expectation of inflation across time, there is a market for that and people do trade that, there is a positive return there. So the interest rate in many cases is actually higher than the expectation of inflation. Now, of course, that can change, but it is a good sign for savers that exists, that there are low risk options where you could park your money and earn a small but positive real return. The second thing is there is good historical data on broad investments, balanced portfolios, for example, beating inflation over time. In episode 1, we spoke about types of investors, if you remember, bucketed them, types of portfolios, cautious, balanced, and aggressive, where cautious was, a lot of government bonds, not a lot of stocks. Balance was somewhere in the middle, and the aggressive was much more geared towards the stock market generally. The good news is that the historical data that we have does show that taking risk can or has historically allowed returns or created returns that are in excess of inflation and have created real returns in that sense. So it's not just your savings number is getting higher when inflation is higher, it is that the overall real value of your investment portfolio would have risen in this past example. Now, as I said, you can never guarantee the future. That is the beauty and the curse of investing. But the data that we have go on does lend some credibility towards making that decision and taking a bit of risk there. Now, that is all we have time for today on the Zurich Money Mindset Podcast. Please do not forget to like, comment, and subscribe. And actually, in all seriousness, in terms of comments, it actually would be interesting, in terms of comments, to know what are some topics you would like us to talk about or questions you have generally. So please do. Thank you very much.